It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Well, hello. Thank you for joining me again. It's Tyrone Jackson, a wealthy investor. Welcome back to another episode of Trading Stocks Made Easy. Everybody knows by now, if you listen to the show on a regular basis, that you can follow my stock trades by becoming a member of witradeschool.com. And that's really where I keep you apprised of what's going on in the stock market on a weekly basis. We have a lot of stocks that are very volatile right now. And what do I mean by volatile? You see, during the day, every single stock has movement, right? It may move 25 cents up or down each day. Some stocks actually move $3 a day. And in that $3 movement, known as volatility, there are trading opportunities, right? So I can buy the stock at one point during the day, have my software actually sell it when the stock moves up. And that is volatility trading. Now, inside of Trade School, each and every week, you can actually send me your stock market questions, and I will answer them to the best of my ability. Sometimes some of the questions go far beyond just trading, and we can get into tax issues, et cetera, et cetera. But one of my students, Dawn, sent in a question, and it was so fascinating to me. I said, we're going to do a podcast episode on that rather than having me answer the question inside of Trade School. So Dawn, you know who you are. Look at this. You're in the big time, baby. You got a whole show devoted to just your question. So today I'm going to talk to you about index funds, ETFs, and private equity. Index funds, ETFs, and private equities. Now, whenever I'm teaching anything about the stock market, I always ask that you keep an open mind. Because why is it that the rich get richer? Well, they have something called a financial education. Now, what I like to say at a lot of my live events, mostly in New York and Los Angeles, when I go before an audience, I always say, imagine for a moment that you came from a family worth $300 million. $300 million. If you came from a family worth $300 million, there's a high probability that something like this will happen for you. Around your 22nd birthday, your mother, your father, or your primary caregiver would say to you at some point, look at this list and look at the people whose names are on this list. And you say, oh, well, look at this, Jenny and Frank and Mark. And your father probably would say, I want you to call Jenny, I want you to call Frank, and I want you to call Mark. And you would say, well, why do I have to call those people? And they would say, well, I want you to set up a meeting with them because those people handle our family's wealth. So you look at Jenny and you say, well, that's really interesting. Jenny is our tax person. I guess I should probably call her. Mark does something with equities, and John or Peter or whoever it may be does something with real estate. So you call each one of these people and you set up a meeting. And what those people do is they actually explain to you your family's holdings and the implications, profits, or tax ramifications of everything that's going on. So let's say you call the real estate guy first and he goes, oh yeah, your family owns strip malls all throughout the country and in Canada. And here's how much those strip malls actually earn. And you have a vacancy rate of, let's say, 80%. And you say, wow, we're in the strip mall business? And that person says, yes, you've been in the strip mall business. Your family's been in the strip mall business probably for over 25 years. Wow, I didn't know we had strip malls as assets. And then you call the other person on the list and they say, hey, you know those strip malls, every time you take in rent from the tenants, it's taxable. Let me show you exactly how we handle those taxes. And you go, oh, well, that's interesting. And then you call the next person on the list, you set up a meeting and they say, oh, here's your equity portfolio, meaning stocks, your municipal bond portfolio, and here's how they all play off of and interrelate to one another. And all of a sudden, you get a picture of your family's $300 million wealth that you didn't know before. And you now know that that portfolio is broken down into stocks, bonds, real estate, and tax strategies. Now, why is this scenario important? Because those people would be teaching you, they would be mentoring you through the process of generating wealth, managing wealth, and the tax ramifications for it. So what I always say when I'm speaking live is, now imagine for a moment that you did not grow up in a family worth $300 million. Who taught you about real estate, tax implications, and making money in the stock market? For most people, the answer is no one until they stumble upon the wealthy investor. So I think you see my point here. I wind up teaching you, mentoring you, and guiding you through the stock market in the same way that if your family had an extraordinary amount of wealth, you would be mentored and educated. When most people grow up working class like I did, I've said many times on this show, my mother said, make sure you get a job that pays overtime because that's really where you're going to make a lot of money is in overtime. But she used to always say this was her tax lesson. Remember, the more you make, the more they take. So that was the lesson that I got on taxes was get a job. And then secondly, get a good job where you can make overtime. But remember, you'll get screwed because the government will take more of that overtime money in taxes. But that's the best that you can do. So that was the financial tutelage that went on in my house until I actually started getting books and learning and reading about the financial markets, became fascinated with them and started putting money away. So in this episode, here's what I'm going to do. I will be teaching you what goes on in the market as it relates to index funds, ETFs, mutual funds, and private equity. So sit back, relax, and we'll start this episode and this lesson about what goes on in the financial markets right after you take a listen to this.
You're listening to the Trading Stocks Made Easy podcast. Want to learn more about how to trade and invest in the stock market? Visit thewealthyinvestor.net/products. That's thewealthyinvestor.net/products and order the Wealthy Investor's Guide to Stock Market Success audio series. This easy-to-follow 5-CD audio series and manual will teach you the basics of how to buy and sell stocks, how to collect quarterly dividends for life, plus hidden income generating strategies like covered call writing and volatility trading. Start creating financial freedom right now. Get the financial education you need to get ahead. Visit thewealthyinvestor.net/products.
And welcome back. That's right. If you haven't purchased the Wealthy Investor's Guide to Stock Market Success, make sure you head on over to thewealthyinvestor.net and do that. And for those of you who really are ready to follow my trades and to get a full financial education, I need you to start your membership at WI Trade School right now. You'll love it. Somebody recently called it the Netflix for stock market traders because there's over 100 video lessons that you watch over and over and over and over again. And repetition is the key to being successful in the stock market. All right. I am a divorced father of 2 daughters that are growing up so rapidly. One is about to go to college. And I wanted to teach my daughters about wealth building, and I wanted them to cultivate a millionaire mindset from a very young age. So when my oldest daughter was 3 or 4, I started teaching her about the stock market, which of course now is like second nature to her, right? So I used to say to her, what makes a stock price go up? And I had her learn repetitiously to say demand. So I would say, Danica, what makes a stock price go up? She would say demand. Now, I don't know if she really understood what that meant, but even to this day, she really understands the idea of demand. Well, that wasn't completely the entire story. What makes the stock go up is not only demand, but really what I call institutional involvement. You see, when you and I buy a stock, that's a great thing, right? But it means nothing if the large institutions on Wall Street don't also like the stock simply because they have the buying power. So let's take a look at something like an index fund. Now, rather than buying a stock directly, you can buy into a mutual fund that kind of rides along with the stock market. So there are 2 major indexes in the stock market. The first is called the Dow Jones Industrial Average, and that was created by 2 guys who wanted to find a way to kind of measure the movement of stocks overall. And one of them said, hey, how about we look at the top 30 stocks in the U.S. stock market and we see each day how they move as a group. And the first guy's name was Dow, and the second guy's last name was Jones. And they created something called the Dow Jones Industrial Index. Well, 2 other guys across town, I'm simplifying, of course, said to themselves, if you really, really were committed to measuring the activity in the stock market every day, you wouldn't look at the top 30 stocks. That makes no sense. You'd look at the top 500 stocks. That would actually give you a broader view of the stock market on a daily basis. And the first guy's last name was Standard, and the last guy's last name was Poor's. And they came up with the Standard & Poor's, or the S&P 500 index. Now, indexing is a way of looking or judging how well a market is doing on a daily, monthly, or annual basis. And if you're looking at the stocks that have the best performance and, generally speaking, the lowest risk, that is an idea that's acceptable as to how well the market is doing overall. Now, there are some stocks that outperform the S&P 500. So if the S&P 500 as a group in aggregate rises, let's say 12%, there are some stocks that go up 80% on the year. So they are outperforming the index, in this case, the S&P. There are some Dow stocks that are included in the Dow 30, and although the index could be up 7%, you can have a Dow stock that's up 35%. So what are the index funds actually measuring? They're measuring the movement of the stocks in aggregate as a group. So an index fund, an S&P 500 fund, mutual fund, for example, would then try to own as many shares as they possibly can in the S&P 500 to mimic or weight their mutual fund to look like the index. So a lot of people actually like owning index funds because it's a safer way of participating in the stock market. So here's the downside of just owning index funds. If one stock in the S&P goes up 88% and it just pulls the fund up as a group, let's say 7, 12, or 15%, you would have done better actually owning that one stock that outperformed. So a lot of people think of index fund ownership as a way of kind of participating in the stock market poolside. Why? Because you don't actually own all 500 stocks in the S&P 500, but you own the group in aggregate. Now, none of this comes for free because the mutual fund that is the S&P index fund is going to take a series of fees from you. Generally, when you put money into the fund, there's a fee, sometimes referred to as a load, or there is a hefty management fee, basically for somebody else babysitting your money in the stock market. They charge you for that. And then there could be a whole array of additional fees. That's why you always have to read the fine print. The benefit of owning stocks directly is, of course, you pay one commission from your online broker, $6 or $7 to buy your shares, and then there are no more fees. If those stocks in the S&P actually pay a dividend, those dividends are paid to you directly instead of through the fund, and then you have to give up those dividends in the form of fees to some extent. So indexing, as it's referred to in the business, is a great way to get started, but the real wealth will be made for most people in individual stock ownership. So an index fund, an S&P 500 fund, or a Dow 30 fund seeks to mimic the index overall. The downside, if there's a performer in that index, a stock that does really well, you don't own it. So if you have a financial education, one of the things that you want to seek out is what have been the best performers in the S&P and the Dow over the last 5 years. And that's why we love picking individual stocks over index funds, because once you have that financial education, you're on your way. Now, let's talk about what is a mutual fund. What is a mutual fund? Well, a mutual fund is nothing more than a basket of stocks that you're letting someone else actually choose. So nowadays, because everything keeps changing on Wall Street, a mutual fund, you would go and purchase from a mutual fund manager. Mutual funds are not what they used to be. They're a lot more specialized these days. So, for example, you could have a mutual fund that just focuses on semiconductors. You can have a mutual fund that just focuses on internet stocks. You can have a mutual fund that just focuses on beverage stocks. And these are known as sectors. You could have a mutual fund that just focuses on real estate investment trusts, right? So each sector of the marketplace can be divided into a mutual fund. About 35 years ago, mutual funds were a lot simpler, but now the need for competition has created specialized funds. And when you put your money into a mutual fund, you're saying, well, I'm willing to kind of play yet again poolside on the stock market, let somebody else pick the stocks either in this sector to be in this basket Or I'll let someone choose, let's say, pharmaceutical stocks for me, and I'll kind of ride along. So you're letting someone who is a professional choose a basket of stocks, and then you invest in that basket. Now, an exchange-traded fund is much like a mutual fund, but it can have its own mandate. Okay, so exchange-traded funds are fairly new, and if you want to learn more about what they are in particular, they're basically glorified mutual funds. You can go to Google and put in, what are ETFs? Well, you can see right now with all of these funds, hundreds of millions of dollars in funds, not only from the United States, from around the world, how when they like a stock, they help create what? Demand. Now, if you get the idea that there are hundreds of millions of dollars in funds and they all like the same 1, 2, 3, or 4 stocks, that stock is going to rise. Why? Because the funds favor them. So funds, mutual funds, index funds, and ETFs help create demand. Now I want to talk to you about one of my favorite fund structures in the entire world, and that is called a hedge fund. You see, a mutual fund, an index fund, or an ETF you may be able to get into for less than $500. But hedge funds require that you have $1 million or more to participate. Well, what does a hedge fund manager actually do? A hedge fund manager has different goals than, let's say, a mutual fund manager. The mutual fund manager just wants the stocks in their portfolio to rise and collect a fee. A hedge fund manager actually actively manages money for a fee. In other words, they're going to take a piece of everything that they earn. And one of the most popular strategies these days that hedge funds engage in is covered call writing. And you know that that's what I've built my reputation on, being a fantastic covered call writer. And that's what I want you to learn how to do. Covered calls is simply buying a stock and be willing to sell an option to someone you don't know to buy those shares away from you. And that process creates monthly residual income. Now, it's very powerful. And one of the things I love about covered calls is you get to decide how much money you're actually going to earn. And that's, of course, based on the size of your account. So some of my students earn $500 a month, totally guaranteed, selling covered calls. I have other students who are earning $35,000 a month selling covered calls. Now, obviously, they have a larger account and they've stayed with me and they've grown their money over time. And when you grow your money over time, you can actually predict using covered calls how much money you're going to earn on a monthly income. Well, if I'm teaching you how to earn $5,000, $10,000, $15,000, $30,000 a month selling covered calls, then guess what hedge funds are doing? They're selling covered calls with hundreds of millions of dollars so they can earn a predictable $10, $20, or $30 million a month. What a lot of people really don't understand is, why is there so much opportunity on Wall Street? It's because there's a lot of fund participation, and nowadays the internet, like everything else, has totally changed access to information. That means that you have a lot to be excited about, because if you had the right education, you could be a covered call writer and manage your money similar to a hedge fund. Now, where are hedge funds getting, let's say, $50, $100, $200, $300 million to have under management so they can generate $20 million a month? The answer is from very wealthy people. So hedge funds usually have a sales team that go around and find wealthy people, show them extraordinary rates of return that are much greater than, let's say, a mutual fund. And then rich people say, well, I'll put my money out of that mutual fund and I'll put it in your hedge fund. But there's one more place that a hedge fund actually finds money. And here's the amazing part. A hedge fund, if you can believe it, can actually find money from other hedge funds that are called fund of funds. So my buddy has a hedge fund, let's say, where he's managing $100 million. I have a fund of fund where I've got my hands on $200, $300 million that I can then spread around to 3 or 4 different hedge funds. So my job is to pick hedge fund managers who are going to manage money and give me a return on the money that I've gotten from other people. It's almost a little bit like multi-level marketing, but not quite. Now, why am I telling you this? You see, there's so many layers as to what causes demand in the stock market because there's so much money coming from so many different sources worldwide. So here's what I want you to remember about hedge funds is that you don't necessarily have to have $1 million to get started, because when you become a wealthy investor student, I teach you how to do what? How to manage your money just like a hedge fund. Instead of being a mutual fund where we're going to buy a basket of stocks and then wait for them to go up, we're going to manage our money just like a hedge fund, and we're going to create what? Monthly residual income, spendable cash that we can earn from the stock market, trading anywhere in the world, and we have choices. We can take that monthly residual income and we can reinvest it in the long term in stocks that we like in the long term that are members of the S&P 500 and the Dow Jones Industrial Average. Are you starting to get it? Or we can grow our accounts to such a size so that the money that we generate, like a hedge fund, from covered call writing and volatility trading, is how we make our living. So I always talk to you about your mindset. Today I'm talking about getting a financial education, but I have to ask you this question. Would you like to earn $5,000 to $10,000 or $15,000 a month from the stock market for the rest of your life? Would that be better than just, let's say, working a job? Well, if that feels good to you and that's something that you want to pursue, then you need the next level, which is a financial education. Now, let me say this also. There are a lot of podcasts on iTunes with regard to stock market trading, and quite frankly, some of them are very, very negative. Well, for the last 30 to 50 years, the stock market has gone up consistently and created more millionaires, and today, more billionaires than any other pursuit, and that will continue to happen. Why? Because there's so much demand, institutional demand, from index funds, ETFs, mutual funds, hedge funds, and fund of funds, that our markets will always rise over time. So I'm not here to tell you there aren't days that the stock market actually pulls back, but I am here to tell you that over time, if you learn how to pick stocks well, you can create more wealth than you could have ever imagined within a condensed period of time. Now, I take a little hit from this every once in a while in the press because a lot of people say Tyrone Jackson is teaching people how to get rich quick in the stock market. And I'm not teaching people necessarily how to get rich quick, but I am teaching people how to create wealth and financial freedom, and I'm very proud of that. But if you really understand my message with the Wealthy Investor Program and this show, you understand that it's really about getting a financial education so you don't have to rely on a job for the rest of your life. And it's all because you learn how to put money to work for you. In this particular episode, I've talked about demand that's created, which of course my daughter can tell you about. Demand that's created by index funds, mutual funds, ETFs, and hedge funds. Now, right before I bring this particular lesson to a close, I'm going to talk to you about another class of funds, which is called private equity. Private equity. Now, this gets to be a little involved, but private equity funds can do things that are even greater than mutual funds, ETFs, and hedge funds. Private equity funds generally get their money from pensions, and they take that borrowed money from pensions, they manage it in either a fund that it can engage in stock market trading or investing, or a fund that can also buy real estate. Now, these days, private equity really favors real estate. So in addition to having money in the stock market, private equity also has money in real estate, and then they also buy and sell businesses. Private equity, which used to be called leverage firms or leverage buyout firms, essentially what they do, imagine this, because I love this financial game, and I get really excited about talking about this. Could you imagine getting money from Wall Street, let's say, getting money first from pension funds, and then getting money from Wall Street, $20 million, taking that $20 million, buying a business, selling off parts of the business, and within 5 years, that $20 million now has grown a business to $200 million, and then selling the $200 million business. Now, let me say that again. Imagine getting money from a pension fund, making money in the stock market, taking $20 million of the money that you made in the stock market, buying a business for $20 million, selling off certain pieces of it, and then selling off the whole business within 5 years for $200 million, and then taking the profits and putting it back in the stock market. And as they say on the back of the Head & Shoulder bottle, wash, rinse, and repeat, and doing it all over again. You see, the money game in this country is great. And what I love about it for you and I is we can participate at so many different levels. But what's required? A mentor and a financial education. Now, this is one episode I want you to go back and listen to several times. So you just can't say, oh, I've heard of the term private equity, or I've heard of the term mutual fund or indexing. You have a clearer idea of what it is. Why? Because the Wealthy Investor Program is all about leading you in the direction to be financially successful on your own as a self-directed investor, but you need to get a financial education to learn whether you should be indexing in a mutual fund, ETFs, or my favorite, choosing stocks directly. Hey, listen, that music is telling me that I am out of time. I hope you've enjoyed this episode listening to it as much as I've enjoyed actually explaining the market to you in a deeper way. Hey, listen, there are a lot of podcasts out there, and I'm going to say this to you. Stay away from the ones that are negative and go where it's warm. Stay where you're getting the financial education that's going to help you take whatever it is that you have now, grow your money, grow your wealth, and your monthly residual income. Hey, it's Tyrone Jackson, the Wealthy Investor, saying that's my time for now. Sashay on over to the Wealthy Investor right now. Make sure you download our free ebook or start your membership right now at WI Trade School. And next week, I'll be answering your questions directly. Until then, be smart, be safe, be positive, stay open, and great things will happen for you.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.